Hello everybody, my name's Mike Smith, CEO of Horizon Professional. Welcome to another in the video series of Know Your Risk. Today's session is on CFD covered calls. On the surface, a phenomenally exciting strategy, which I've been teaching myself for around about the last 12 months. And certainly I can see the attraction why people may want to add it to their investment toolbox. My job today is to make sure that you absolutely and completely understand the risks associated with this strategy. That perhaps those of you who are thinking of investing your time and money in actually trading this strategy may not yet have considered. So the sell that you'll hear from that smooth talking, slick salesman at the front of the hotel room will be that you can make a monthly income through selling covered calls at a fraction of the cost of buying shares. Obviously, one of the criticisms of covered calls is that the capital required to buy a reasonable sized position over which you can sell covered calls is frequently substantial. Don't believe the hype about it being almost a no-risk strategy and there's $3 available, because we know there's no such thing as a no-risk strategy. My job today, as I've said, is to make sure you know those risks. So how does it work? Well, we know CFDs are leveraged 1 to 10 or sometimes 1 to 20. What we do is we put something called a guaranteed stop loss in place, or GSL, to make sure that if the market gaps down, we are guaranteed to sell our CFD at a specific price. We also sell a deep in the money call, bringing in a substantial amount of income to protect and hopefully potentially profit. So if this income from the call offsets any loss in a CFD, including the fees in all of this, then we profit. So let's give an example. Let's look at potentially a high yield position in XLE, which is the US Energy ETF, which is currently trading around about the $67 mark. So if we were to buy a CFD in this position, rather than $67, we'd be paying $6.70. We could then subsequently sell a $63 call with 5 weeks to expiry at $5.80. Now, how this may play out, if the stock stays above $63, so for example $63.20, then we have a loss in the CFD of $3.80. But we have $5.80 minus, of course, 20 cents to buy back premium from the sold call, giving a total, theoretically, of $1.80. Now that should excite you. That's what is possible. However, there is some big buts. But number one is the fees are substantial. We've got 0.1% in and 0.1% out as your normal brokerage for a CFD. If you want a GSE as well, that'll cost you another 0.3%. So a total investment in fees of 0.5%. Now bear in mind this is 0.5% on the $67, not 0.5% on the $6.70. Plus, of course, on top of that, you've got the likelihood of 2 options trades for your in and out of your covered call position. You've got interest charged on the borrowed 90% for that 5-week period in this particular case, which again is absolutely essential that you keep an eye on this. You need to know your numbers. Bear in mind, these are not real options. They are CFD options. They're all cash settled. There's no exercising going on. They are synthetic products essentially. And they must be placed with a phone order at market prices. No conditional orders here. You're at the mercy of the spread, at the mercy of the market makers, and cannot give an order to the broker to say, if this happens, if my GSL is triggered, then please sell my call. What this means is that you could be left with a naked sold call if your GSL is triggered in the night. Let's look at what's happened in the last 2 days in the market, just as an example of what potentially could go wrong. Yesterday, the market opened 3% down, sufficient in a lot of cases to actually trigger the GSL, having dropped a percent the night before. Now, if this happens, then what you're left with is that naked sold call. Subsequently, the market fought its way back up and ended up around about 0.5% down for the night. The following night, i.e. tonight, what's happened is the market has substantially gapped up by 1.5%. So what essentially we have is over a 4% swing before you could do anything. Is that enough to put your naked sold call in jeopardy and really cost an incredible amount of money to buy it back and put the whole position in a substantial loss? Of course it is. So remember, if you have to close early, at any stage, even without this extreme scenario, the buyback cost of the call could be substantial. So the maths associated with this strategy are really quite complicated if you're going to take into account all of these variables. And there's a huge variance in possible return. The actual optimum return, which you invariably get once you've taken all the fees out, is probably somewhere in the region of between 5 and 10%. Now, the risks associated with this are considerably more than that. So as a risk-reward profile, it's not particularly favourable. However, to be balanced and give the positive side of this, the chances of that risk event being triggered are obviously less than with some other strategies. So although the risk profile is not particularly good from a dollar point of view, from a risk event being triggered, it's actually quite positive. So what does all of this mean to you in light of, is this a strategy you should consider trading or not? Well, here's the must-dos. First of all, you need to know the risk. You need to know your numbers all of the time. You must always have a trading plan and, of course, trade it that includes clear entry, exit and position sizing criteria and takes into account prevailing market conditions. If yields are high, they're high for a reason. You need to appreciate the risk-reward profile of this strategy. It is poor from a dollar point of view, primarily because of the fees involved, but there is a lower chance of that risk event being triggered than perhaps with other strategies that you may be considering. There are other option strategies which have the same risk profile and a better dollar return, achieve the same goals but with less fees. So what I would say is you need to explore these other strategies and see if these are a better fit for you as an investor. You must never leave this sort of strategy to the market gods, placing it and then thinking everything will be okay and retouching base with it in a week or so. It just doesn't work, and you could get yourself into all sorts of financial trouble by doing that. You should not ever enter a position and sell a call purely on yield only. As I've said before, yields are high for a reason. Yields are high because the underlying stock is more volatile. That means there is a greater likelihood of that risk event being triggered. And never ever forget there are changing interest rates or LIBOR, and if you're not sure what LIBOR is, that's another part of your due diligence you must do, could influence the fees significantly. So, you need to trade safe. And the only way to do this is to know the risk of any strategy that you consider learning and also investing your hard-earned dollars in. Now, as I said, we've taught this strategy for over a year. And so feel free to email us with any questions as to how you can trade this and perhaps some of those other option strategies with confidence at the email address below. Or come and see us on www.eliteoptiontrading.com. For now, my name's Mike Smith. I'm delighted you've invested this time in knowing your risk in greater detail. Take care, trade safe. It's been a pleasure and a privilege, and I look forward to sharing some stuff with you again in the future. Goodbye for now.